What's up, guys? Welcome back to another episode of Mind Something. If you're new here, my name is Jake, and in today's video, obviously, this is the face reveal, and I figured what better time to do it than an interview because, let's face it, it leaves a lot to be desired when you can't see people's facial expressions while they're having a discussion. So, from now on, you know what I look like. It's out there in the open. Hope it's not a disappointment. But let's go ahead and jump into the conversation. Awesome. All right. Well, today I am joined with Dr. K from the Quai team. And Dr. K, thank you for being here with us today. I know you are a very busy man, but you took the time to sit down and talk with me. And I think that it's extremely important because we got a large audience of miners that are potentially going to watch this video. And I think that you've got some messages that you would like to share with them. But before we begin, if you could just tell us a little bit about yourself, not necessarily how you got into blockchain, but anything that you want to share with the audience, perhaps where you're from or what you're into, and maybe then we'll get into how you got into crypto.
Yeah, I originally grew up in Iowa, but I've been in Texas for about the last 15 years. I have a background in engineering, um, and I like Texas for its libertarian ideals. So, uh, also one of the reasons, I like things like Bitcoin.
Excellent. Well, speaking of Bitcoin, if you would just tell us, what was your aha moment with crypto? What really got you to dive in and start investigating further, and perhaps how long ago was that?
Yeah, so I kind of found out about Bitcoin. Um, The first time I heard about it was actually on NPR, or the Nipper, as I like to call it. This is before they went off the rails and became just complete communists back in maybe 2011. And they were talking about how individuals were using this in San Francisco to buy drugs from Amsterdam online. I was like, okay, this is interesting. Internet money. Okay. So I looked into it a little bit. Um, and when I first looked at it, right, it always looks a little weird, to be fair, right? Like, how does that work? How is this scarce? This seems kind of like a scam, a Ponzi scheme, something like that. But I was like, okay, digital money, let's just YOLO some money into this and then see where it goes. Um, and I started looking at how to get it. And at the time, the way to get it was you had to get like a phone card at Walmart using cash so that you could get an OK Pay card out of Asia somehow, so you can convert it to a receipt on Mount Gox, and you could get these Bitcoins. So at that point in time, I was like, this is the dumbest thing I've ever heard. There's no sort of ways to convert this back and forth between fiat. Uh, I'm gonna pass. So I passed on it at that point. But it got me looking into the money system. And at that point in time in history, it was actually really hard to figure out some things that we take for granted today. So when people online in Bitcoin talk were saying, oh, the Federal Reserve is not part of the federal government, that was a highly sort of conspiratorial thing, and it was actually hard to verify.
Uh-huh.
Um, Nowadays, if you just Google Federal Reserve, you can see the St. Louis Fed's website, and it explains that the Federal Reserve is owned by the sort of member private banks and their shareholders in the Fed, and they get dividends from revenues, so on and so forth. So you can understand the structure, and you do realize that it's not a federal entity; it's rather a private entity.
Mm-hmm.
Um, and then you start to understand the relationship between it and the Treasury and how bonds are issued and paid back and so on and so forth. But at the time, that concept of how money worked was a very hard one to understand. Now, the interesting thing is once you understood how money worked in our traditional system, which we just sort of take for granted because we just use it with, prior to Bitcoin, no one really understood how it worked. Um, Once you understand how it works, and then you go look back at Bitcoin, you're like, ah, I see what you're doing here. So it wasn't really an issue understanding Bitcoin or the sort of cryptographic nature or the incentives of Bitcoin. It was understanding how money already works
Mm-hmm.
to be able to properly classify Bitcoin and how it works relative to what already existed, was kind of like that leap. And that took about a year. So sometime in 2012, I was like, okay, now I got to go buy these things at a much higher price than I could have a year ago.
Uh-huh.
But let's go.
Yeah, it certainly does require an education in the current monetary system before you can truly understand how important Bitcoin is. And I think I personally had an experience much sooner than Bitcoin, kind of diving into how the mechanics of all of that worked and essentially just being a Ponzi scheme. I don't know if you're familiar with a movie called Zeitgeist, but the original one that went over the monetary system, that was very early days. I think I was maybe still in high school at the time that I watched that. So I've been paying attention, as much as we'll say, 20 to 30-year-old could at that time. But then when Bitcoin came out, I think I really didn't start paying attention until probably the end of 2013. But ever since then, I've just, here I am interviewing guys such as yourself, and trying to continue the education even further. And again, thanks for being here to kind of help explain all of these things from your perspective and from the perspective of Quai, which is a very, very interesting project. And I wonder if you could tell us kind of how you got involved more in depth with the space, other than just speculation on the price of Bitcoin.
Yeah. So I actually worked for a couple years. I actually started working in '08 after my bachelor's. Um, and I worked in electric hybrid vehicles for a bit, doing research. I decided to go back to school and get my doctorate, and I finished my doctorate in 17. And during my PhD, that was maybe a year. I started a year after I kind of like discovered Bitcoin. So a lot of my time in my PhD, right, I was sort of getting my PhD in engineering, but I was also um, getting a side PhD in blockchains, cryptography, and game theory, so to speak, just because obviously it was so interesting. So, I was researching it throughout my PhD, looking at the different problems, the different systems that were coming up to solve these different issues. Um, but then formally got involved with it in 2017 when I graduated. I thought about quitting my PhD for a while, but circa 2013, 2014, there wasn't really an easy way to get a respectable job full time um, in Bitcoin or crypto. So I finished my PhD and then I went to work for Consensus. Worked there for about a year, and then I did a spin out from Consensus called Grid Plus. I designed, built, and sold the Lattice One hardware wallet.
Okay.
So it's kind of this point of sale sort of terminal looking thing. But the cool part is it abstracts seed phrases into debit cards or smart cards. So you can then use crypto like you use a debit card, and you don't have to really understand the seed phrase, right? Kind of my goal with crypto, and one of the things that I was learning along the way, researching these systems, is that to be resilient at scale, they have to go to scale, right?
Mm-hmm.
Scale resilience requires scale. I'll put it that way. So there's a couple barriers to scale. One of them, what I was focused on with the Lattice One, was the UI UX, specifically around managing seed phrases, right? So my sort of baseline is if I could get my 65-year-old mother to be able to use this thing, we've succeeded on the UI UX. So if I can abstract crypto to a debit card and she can just use it like a debit card, then like we've succeeded in crypto. Now, when I was there though, I started to realize that even though there is this UI UX problem and it is solvable, the bigger problem is scalability of the underlying technology itself. So even if I can use it like a debit card, because I can't get the transactional throughput, and you get this sort of clunkiness and fracturing of liquidity and issues with layer twos type scaling solutions. I really said for this to work at scale and be resilient to nation state level attackers, you need to scale the system. And if you can scale the system, you can generate sort of as much revenue as you possibly can from transactions, not only creating this long-term economically sustainable market, but creating as the highest sort of economic Byzantine fault-tolerant system as possible, as well as creating a socially resilient system. So the other thing that I've like come to sort of realize is there's like two types of resilience, right? In Bitcoin, we talk about proof of work. Love proof of work. It's the only sort of immutable way to get finality in a distributed system. Um, but on top of proof of work, you can get social resilience if everybody is using that system economically. So if it's just a few million guys who are libertarians sort of speculating on it, that has a certain degree of social resilience. But if it's, a mom paying for her groceries and filling up the gas in her car with it, that's a different degree of social resilience because politically speaking, you can screw with a couple million tech bros speculating on an asset. But if you're preventing somebody from buying food for their children, it's political suicide. So that's like the ultimate way that you get a system that can displace the current financial system. You need the highest degree of economic Byzantine fault tolerance possible. So you need as much revenue to the chain as possible, which you get from the greatest throughput possible. And then with that, you can gain social resilience because it's used economically.
Gotcha. Okay. And all the mechanics of this are extremely difficult. Once you solve for one thing, then you discover another problem, right? And Bitcoin has a 14, 15, 16 years going on at this point of experimentation for us to learn from, but it seems to be somewhat ossified in its current state because we don't want to jeopardize the value that it's built now. And obviously we've gone back and forth trying to change it, but there's many different projects that are attempting to solve the problems that we've discovered per se with Bitcoin's ability to become a payment method, a peer-to-peer payment method, scalable for the masses. And I think you have some very interesting ideas on how to solve this, and Quai is going to implement those. But I kind of want to tackle today's subject matter with miners specifically in mind, because they want to know how all this stuff's going to work, and how do we get paid, and what are we getting paid, and what exchanges are we getting listed on. But before we get to all of those things, there's probably a lot more that we need to uncover before we get there. So I think maybe if you could tell us a little bit about what prompted you to have the idea for Quai, and perhaps what makes it different from everything else that's trying to solve these same problems.
Yeah, so the idea for Quai, I obviously, right, like I said, I've been thinking about these things for quite a while, and reading papers, observing, and learning. So kind of sort of collecting the issues and the thoughts on the state of the art and how to address issues sort of over time. Um, so I'd been thinking about this problem for like probably like 5 years. And then in 2018, I kind of came up with this idea of a hierarchy of merge mined blockchains as a mechanism to shard and subnet a work-based system without sort of compromising, excuse me, without compromising security. So the question is, can you shard state without quote unquote sharding work? And then can you get the miners to sort of participate in a way that helps them optimize the network performance, not just the hash rate? And so that initial idea was called block reduce. Excuse me. And block reduce, I proposed this to a prof. This was after I graduated with my doctorate at UT that I knew. And we actually were able to get a National Science Foundation grant to do research on this topic of scaling proof of work blockchains. So we did that for a couple years. I did it part-time because I was at Grid Plus. And then in 22, I moved over from Grid Plus. One of my collaborators was able to raise money from Polychain, and I've been working on this full time since the beginning of 22 to actually take that research and bring it into the marketplace. So what the sort of unique features of it is one is it's proof of work. Two is it's I would argue, the first truly sharded proof of work topology. There's other systems like Cadena, but if you look at how Cadena consensus works, it doesn't actually allow people to run validation on partial state. So what that means from a miner's perspective is you sort of have this hierarchy, right? You have what we call like a prime chain, region chains, and zone chains. And as a miner, you get to sort of self-select where you mine. So you kind of have to mine prime. You get to pick a region, pick a zone under that region. And when you're mining, your node is actually proposing a header that's valid in those three contexts at once. And then you're just mining a single nonce. So this is sort of the merge mining piece. But the cool part is you don't have to monitor like all state of all the chains. You just have to monitor and process state in one chain. So what that means is that as the number of shards increases with demand, the node requirements stay roughly constant. So if we do like 1,000 TPS in a shard, and that takes about a 16 gig RAM, 3 terabyte, 8 to 12 CPU machine. When we go to 2 shards, or if we go to 3 shards or 4 shards or 5 shards, the miner's requirements will stay roughly constant. So there's a little bit more overhead, but it's basically roughly constant. So you don't need some like big, crazy, multi-$1,000 per month server to be able to run a node. You can run a node on something that's akin to a modern laptop at this point.
Okay. And we're currently in some test nets, but we're getting very close to the end of this, and we'll be going mainnet here pretty soon. But can you kind of elaborate on what's currently happening with the test nets and what we've already accomplished with the previous ones?
Yes. Sorry. Man. Pollen or something this morning. The previous testnet was called the Iron Age testnet, and that was our third testnet, but that's the one where we really showed that this sharded topology could work. So we had a 9 shard system running for about 5 months. And I think we had about 2,200 nodes running worldwide. We had about 7,000 GPUs participating. We did over 1 billion transactions. We showed in the live setting we could do 2,000 TPS in the 9 shard topology. We've since improved upon that quite a bit. We can do about 7,000 in a 9 shard topology now. But to give perspective, 2,000 TPS is higher than Visa's average transaction throughput during the year. They do about 1,700 on average. So with that Iron Age testnet, we showed that in a decentralized system, using proof of work like Bitcoin, we could do Visa level throughput in the single system. So that's kind of what we showed in the last testnet. What we're focused on in this testnet, and one of the other things we learned is you don't want to have more shards than you can economically are economically demanded, because the highest amount of security and the fastest finalization happens if you have the fewest number of shards needed for the throughput required, if that makes sense.
I got you.
So what the system does is it actually starts out at a single shard, and then it measures its uncle rate or orphan rate. And basically when the orphan rate starts to like rise as the sort of block size rises, eventually what it's telling you is that shard can no longer handle demand. So if that uncle rate is sustained for a period of time, the system just automatically says, okay, we need a second shard. And then a second shard sort of becomes available to mine. And then if it rises again, then a third shard becomes available, and it keeps opening up as the demand keeps increasing. So it's sort of an auto-scaling system that's measuring its own performance to figure out how many shards to have.
Interesting. Does it reduce the amount of shards based on network congestion or lack thereof?
That's the only thing we can't easily do. If like we wanted to like be perfectly economically optimal, we would want to do that. But up to this point, it's been proving too technically complex to be able to squeeze back down.
Gotcha.
So that is sort of our one thing that I would say is not economically optimal. Everything else in the system, like we're really trying to get economic optimality. But in the current testnet, to get to it, we're starting in a one shard system. We'll expand out to multiple shards during the testnet to sort of test that feature. But what we're testing now is actually Qi. So instead of just thinking about this as a technical problem, we've also been thinking about this as sort of a monetary economic problem. And when we look at something like Bitcoin, we said Bitcoin's cool, but even if Bitcoin could go to say 50,000 TPS, it still wouldn't make good money for really two reasons. One reason is that it's not sort of a numeraire, right? It's not a unit of account. So if you look at crypto today, 70% of transactions by value are actually happening in stables, not in the native tokens. That's telling you that the market wants, a stable reference point when doing, contracts and settlements. Fine. The other piece is that Bitcoin is technically what Gresham would refer to as a superior form of money. So if I have Bitcoin and I have dollars, I will always elect to spend my dollars before I spend my Bitcoin because of an expectation of future expected value. That would mean the dollars are the inferior currency and the Bitcoin is the superior currency. Now, the problem with that in the long term, though, is as the inflation subsidies of Bitcoin go down, the proposal is that the fees are going to rise to offset the decrease in the subsidy. But at 5 TPS, fees would have to rise precipitously to offset the decrease in the subsidy. Now, if we went to a higher rate, means that Bitcoin can scale, there's still the problem of can you get people to use Bitcoin transactionally if an inferior currency exists, because they're still going to have the tendency to hoard it, right? So you kind of need this incentive in the system to get velocity in a proof of work setting if you want the fees to be the mechanism by which security is procured, right? So the idea here is that you need to have two types of currency in a proof of work system. One that encourages hoarding to get adoption and act as a store of value, and one that encourages velocity and also fulfills the need of a unit of account. So we introduced this concept of Qi. We call it an energy dollar. And we sort of peg it to the price of production of a hash. And that price of production of a hash is related to electricity costs, as miners well know. So that's why we call it an energy dollar. So the way we've sort of constructed the game over time is that if markets are rational and miners are rational, Qi will follow the rate of the price of production, i.e. energy, with time. So it'll have relatively stable purchasing power over time related to energy costs. And that allows us to create what I would call an endogenous stable-like token in the system. So it doesn't have a peg, it's not sort of referential, it's not backed, it's just an endogenous reference point that the miners are producing by participating and optimizing their mining activities. And it creates that unit of account in the system. So that's really kind of one of the things we're focused on testing is Qi. And the other thing that's really cool about Qi too, for the Bitcoiners out there, is it has cash-like properties. So Qi is based off a UTXO ledger that's fixed denomination, and in protocol we enforce account non-reuse per block. And with those sort of lightweight design choices, you'll get an emergent property where the Qi ledger has cache-like privacy.
Interesting. Now, if I didn't have any manners, I would have skipped all the pleasantries and we would have dived straight into this subject matter that we're about to get to. I find this extremely fascinating and a different approach that I don't think anybody else has taken. And that's really one of the reasons why I wanted to have a conversation about this, to bring some awareness to this. I would refer to it as somewhat of a reactionary equilibrium mechanism. And it'll be really interesting to see how the dynamics of the market cause fluctuations between Quai and Qi. If you could maybe go a little bit further into maybe some projections that you foresee initially, and then what will happen over time as miners are getting paid in their choice of Quai or Qi, and how those forces of the cost of electricity will affect, who caves and who decides to hold, and how all of that will play out.
Yeah, great question. But before I get to that, I do realize I didn't get to the meat for the miners who are like, how do I participate? So let me just
Sure.
throw that in there for Golden Age. So we have a ProgPoW based hashing algorithm. So it's GPU friendly. So if you have GPUs and you know kind of how to run Hive OS and point it at Stratum, you can mine in Golden Age. And Golden Age is sort of like a fully incentivized testnet for us. So the number of tokens that exist when we kind of end Golden Age and take the snapshot will pro rata turn into 10 million mainnet tokens. So it's an incentivized testnet, basically. So if you mine and you can mine more coins, then like you'll get money, and that money will turn into mainnet tokens. So to cover that problem, now to get into this problem, there's many levels of this onion, right? The first level. Let me just describe the mechanism first, and then we can describe like the strategies. So the way that this works is there's two mechanisms in the system. One mechanism is we issue Qi proportional to hash. That's mechanism one. Okay. So I can basically price Qi in hash, which then prices it sort of in electricity, kilowatts, or dollars. So there's kind of a relationship. So if I say, one Qi is worth 3 to the 12 hashes, we can roughly say that's worth $1 or $1.20, right? And so what will happen with that mechanism is if the if the market price is above the price of production, miners are then incentivized to mine it to produce more until the market price goes down to the price of production, right? You create that equilibrium point. So that's mechanism one. Now, mechanism two is, let's say there's too much Qi in the market and the market price is below the value of production. There's an exchange rate that's available in the protocol that allows you to convert Qi into Quai at sort of this protocol determined rate. And the second mechanism in the system is deciding what that protocol determined rate is. But the way that we do it is we measure the trailing flows between Quai and Qi, and we set the price offered in the protocol to make the market neutral to the rate, if that makes sense. So if the people wanting to convert Qi to Quai and the people wanting to convert Quai to Qi, if those flows are equal, that means the market has neutral preference to the rate being offered, which means the rate in the protocol matches the external market rate.
Got it.
If that makes sense.
Yes.
So we're just sort of using the miners, and there's also speculators here too, because speculators can just take capital and sort of move Quai to Qi or Qi to Quai, and we're taking their preference to measure the market relative value of the two. Okay, so there's a physical tie point, which is saying Qi is equivalent to this much hash, and then there's a market measurement point that's saying this is the relative price that the market is clearing these two assets at.
Gotcha. And would you refer to that as a burn mechanism?
When you convert, yeah, it's a burn and mint.
Okay,
Yep.
gotcha. Awesome. So when miners are mining, they are forced to receive it in Quai or Qi or a combination of the two?
They get to choose.
They get to choose. Okay.
They get to choose. So we'll get to layer two of the onion now. So you kind of get the market mechanism a little bit. Layer two of the onion is, how does this work, and how does this work from a cold start? So the way this actually works from a cold start is the control we've designed is adaptive, and we're able to sort of deconvolute sort of the hash rate influence from sort of the market preference, and then sort of fit a curve to market preference to understand pricing. Now the problem is we can only do that if the market has enough rational data coming in that we're measuring to like rationally fit to. So initially the controller is non-adaptive. The controller is just offering sort of Quai or Qi, but it's relative to the changes in difficulty. So when we emit Quai is emitted proportional to the binary log of the difficulty, whereas Qi is emitted proportional to the diff. So there's this natural sort of diff over log diff curve that exists in the system initially. But what that means from a miner's perspective is when the controller's not adaptive, they don't necessarily have to worry about market pricing. They just need to worry about relative pricing in the system. So basically what it means is the sort of 0 point strategy is if I like think this is the diff that's going to be the future value, if I'm above that value currently, I should mine Qi, and if I'm below that value currently, I should mine Quai. And then when it renormalizes back to my expectation value, depending on what I want to do, then I'm going to either exchange Qi for Quai or Quai for Qi, depending on sort of my choice. But to make more money, if you think the hash rate's high, mine Qi. If you think it's low, mine Quai.
Okay. Yeah, it will be
So that
very interesting to see how the market reacts initially, but long term, like what is your goal of that mechanism, and what was the reason for the implementation? Because I know it's very strategic, and I feel very confidently that at some point we are going to get away from fiat based stablecoins. And if you could maybe elaborate on the reason for why you would prefer to get away from fiat based stablecoins.
Yeah. Let me just state sort of the next evolution of the controller,
Sure.
and then we'll
Sorry,
do
go
that.
ahead.
The next evolution. So like if you think about what that first stage is for the miners, they can really just think of the two tokens as like a hash rate future. So Qi sort of lets you speculate on the future hash rate in the system. So it has immediate utility, which means then people will rationally use it in the system. And what that sets up for us is it sets up that first degree of rationality, which is choosing Quai or Qi relative to changes in the difficulty. Once we see that emerge out of the market, then the adaptive controller can turn on, and then that starts to tie that to the market pricing. And then that's how you get like the fully closed loop. At that point, then you would expect Qi to sort of track the production price over time, which then creates that stable. Now, the reason we want to do it is manyfold. But I think I'll start with if we look at decentralized systems and we see that the market is demanding stable tokens, we need to understand what those stable tokens are doing to the decentralization in these systems. So if we look at USDC, if it's trading on Ethereum because it largely trades on Ethereum, the issue you have is that USDC doesn't exist in Ethereum. It exists in a bank, right? It exists in SVB. It exists in Silvergate. It exists in wherever it exists, right? And the only thing that exists on Ethereum is a receipt, right? And people talk about TVL. There's no value in USDC. The value sits in the bank, right? All that's sitting on chain is the receipt for the value that's sitting in the bank. So there's no value locked in the chain. What USDC does to Ethereum is it creates an interchange network, and much like Visa or MasterCard. So then all Ethereum sort of getting out of that, ideally in long-term equilibrium, is like a fraction of a point on, facilitating transfers as sort of a nouveau version of Visa. But all of that value is in the bank. So the system itself is not benefiting from that value, and it's not generating a ton of revenue that goes towards security. And it's not even really putting capital into the system. The capital exists outside the system. So that's sort of the baseline. Now, what's it actually doing to Ethereum? The problem is it's making Ethereum dependent on the financial institutions. It's making it dependent on the banks, and it's putting the control of Ethereum to the people that control the banks, right? So let's just sort of do a hypothetical. Circle and Coinbase sort of run USDC. There's $160 billion worth of stables circulating. And if Janet Yellen came in and said to these guys, hey, do this to the Ethereum protocol or else we're going to take away your banking license. And they said that to these guys that have enough influence in the system that they can have a plurality of stake. They would do it. And if the system sort of forked off, the other sort of lever they have now is the fact that they can determine sort of the outcome of where this $160 billion worth of receipts lies, right? So if there's like a split in the system, and you got like the cypherpunks over here who are like, okay, we're not going to create KYC blocks for every account or whatever it may be. You like fork off, they're going to fork the other way and take all the USDC with them.
Hmm.
right? So then there's this huge magnet of like what the outcome of the fork is relative to the location of all of these hypothecated assets. So you've kind of damaged the consensus mechanism, right? Because you've created this orthogonal incentive system, an orthogonal piece of control that's ultimately controlled by the treasury to dictate where the system goes, right? So I don't think you can fundamentally have an independent decentralized system, one, without a stable token, and then two, you certainly can't have it with a stable token that's built on the current fiat system because you're just handing the keys back to the people that run the system.
Right.
It's no longer decentralized.
Totally agree. And very few people understand that. But, with these types of conversations, we'll certainly bring some awareness to that particular quandary. And in all of the different real world assets that you could choose, I think miners will really appreciate the fact that uh, energy is perhaps one of the best choices as opposed to other types of assets, whether it be real estate or any other type of commodity. But maybe you'll probably do a better job than I could in elaborating why energy price is so important to choose in this particular mechanism, especially when it involves crypto.
Yeah, well, I mean, there's two reasons for it. One is, um, I'm very conscientious about the impact of choices on decentralization. So the one of the reasons that energy is such a good choice is because if you're using miners for consensus, you can also use them as the oracles. You can also use them as the market makers. So if I use that one process for all of these things, I'm not creating sort of bifurcating incentives or alternative dependencies for the decentralized system to work. It all just falls back to hash rate in the miners. So that's sort of one point. And then what the miners are doing, if I'm talking about what quantities I can get out of the miners, electricity like is sort of the fundamental quantity that I can get. Um, so that's why that's designed that way. If we said, okay, we're gonna have an oracle and we're gonna sort of reference the dollar or something, okay, now I have like an oracle dependency, I have a dollar dependency, I have like liquid market dependencies that are all outside of the consensus mechanism, which is mining. But when I say the miners are oracleizing the system, the miners are participating in making the markets, and the miners are the ones securing the chain, right? Then it all suddenly makes sense because that one quantity that's securing your chain is also doing all of the other things. So there's no bifurcation in um, sort of the security or the incentives. It's all sort of hyper aligned. Now, from an economic perspective, if we think, okay, how does energy play in our society? Energy is the most fundamental unit of account in society, 100%. Like if you look at uh, economies around the world and you just look at quality of life, wealth, and everything, it's all perfectly correlated with how much energy that economy can create. Because energy, like, is our well-being. Energy is our economic production. So, and energy, ideally, if we look at um, an efficient money system in capital goods, the cost of any given competitive good should reflect the aggregate energy that went into that good. So that's the other thing. Like if it's a competitive good, I'm really just paying for the net energy that went into producing it when I'm buying it. So energy is sort of the most fundamental unit of account in society. So it has this great property that I can get it out of a proof of work system. I can do it without creating other dependencies. I can like keep everything sort of secure all the way back down to sort of proof of work mining. And then it's also just a very good referential unit in the economy, potentially better than any other referential unit that's ever existed for pricing goods and services.
Agreed. But regionally, when you do break down the cost of energy, there are some variations from one geographical location to another. Do you see that perhaps that could play a role initially when we're in price discovery, that it has anything to do with the region, will it just, equalize based off of all participants and what their energy prices look like?
Well, so there's going to be one sort of clearing market, right, for the actual tokens. I mean, much like Bitcoin, right? When you look at Bitcoin miners, right, no Bitcoin miners in Germany paying 40 cents a kilowatt hour. All the Bitcoin miners are finding the places in the world that have competitive energy prices. So they're kind of mining in the lower quartile. And then if we look at sort of the competitive price of Bitcoin, when it's sort of there's some convolutions here, obviously, but if we said that the stock to flow was like equal, the price of Bitcoin is then roughly equivalent to the price going to mining plus like a little bit of profit, right? So when things are sort of at equilibrium, the market price of Bitcoins may be 10% over the production price, right? And then sort of we get changes in demand and whatnot that are up or down and can go above and below. But if everything was in equilibrium, the miners would make like a nice little 10% profit, and the price would always be 10% above their production cost, which means that everyone's like pushing out into this like bottom quartile of energy, and sort of that mean of that bottom quartile is going to be the Bitcoin price for that difficulty for that point in time. Now, the difference here with Qi is because we always are proportional to hash rate, not on some sort of arbitrary schedule. That price should then be consistent over time, meaning then all of the Qi that's emitted kind of feels like a dollar roughly in purchasing power over, time horizons. It doesn't, continually go up in value. So that in our system is what we would call, in Gresham's terminology, the inferior currency. But what I would call is the circulating currency, the unit of account, and the medium of exchange. So when I go to sort of price contracts and pay people, I'm going to do that in Qi because it has these cash-like properties. It has this unit of account. So even though it's maybe slightly inflationary, and that's by design too, by the way. So one of the dynamics with Qi is the market will actually increase or decrease the supply of Qi with time depending on demand, because it's always working to change the supply to match demand so that the price stays consistent. So if there's sort of times of high demand, the supply kind of increases, and if there's times where sort of there's less of demand, like the supply of Qi would shrink, through that mint and burn mechanism. And that's very much by design, but that creates your velocity money in the system, which then goes to pay for your fees in the long-term equilibrium of the system, right? Because with Quai, it's a deflationary token. So it's meant to sort of, have this inflation that approaches zero over time, much like Bitcoin. But to do that, we need to offset that with transaction fees, and that's really where Qi like shines, is that in that long tail, it generates the fees because it encourages velocity.
And when it comes to fees, in my opinion, it can be somewhat of a double-edged sword. You take, for example, Ethereum at the peak of its euphoria. Fees are costing more than the transactions themselves, and in my opinion, that is a failed system. Right? That is not something that instills a lot of confidence in me. But we we have to have these mechanisms. There has to be an ecosystem. There has to be incentives, rewards, and all of these things. How do you envision transaction fees playing a role into this when we get to the tail of the emission, so to speak?
Yeah, so we envision transaction fees, playing a role as soon as we can kind of scale the system. And so with that, we actually created sort of a rational market for transaction fees. There's actually sort of like a whole litany of things that have never been addressed in blockchains, and they're what I would call mal-designed incentive systems. And some people know about them, but like they've never been fixed.
Mm-hmm.
So one example is there's no incentive for a miner to propagate a transaction. At least no instantaneous incentive. Their incentive is in long term as a bag holder. They want to do it, else the price of the asset will go to zero because no one will get transactions in. But instantaneously, the rational behavior of a miner is to not broadcast transactions to anybody else in the system. That's one sort of mal-designed market. There's another mal-designed market, which is how do you discover the price that should be charged for a transaction in any given block? Like, what is sort of your fee rate? Um, so we have a solution for the first one. We can get into that, but we also have a solution for the second. Um, and some of this isn't rocket science, but basically we just use a second price auction, or some people might refer to that as reverse Dux auction. So what happens is the miners order the transactions in the block by fee, but then the fee that's offered is the one that's the last included price in the block. And what that does, provably, is it creates what we call a dominant strategy incentive compatible uh, system, wherein the market demand is matched to the market supply, and we maximize the aggregate economic surplus for all participants in the system. So, right, if we look at microeconomics, which is actually, a elementary form of game theory, but is correct, right? When you want to set price, you always want to set price where supply, meets demand, and then you maximize that aggregate economic surplus for everybody in the system. So by doing an RDA in the block auctions, you get discovery of price in an economically ideal way.
Interesting.
So like you don't want zero fees, you don't want really high fees. So one of the reasons we can do this is because, right, our block space can keep increasing. And then once we kind of tap out in a shard, we just add another shard. So there's always a ability for the market to keep adding supply, which means we can always match supply to demand. And then the economically efficient way to do that is through a second price auction.
Interesting. I I feel like we might lose some of our audience members if we get too technical. So I want to kind of bring things back down just a little bit and kind of talk to the miners here for a second. If you could tell us, ProgPoW's the algorithm that we've gone with. A, why did we choose that? And B, um, what does the future hold for coins? And maybe this is too broadly speculating, but coins that continuously shoot for ASIC adoption. What was your thought process in choosing ProgPoW, and how do you think that it's going to affect other projects going forward that don't go with that?
Yeah, so the reason for choosing ProgPoW is we want decentralization in mining. So if you look at ASICs, ASICs are centralizing because they have higher capital requirements, and they also have more constrained makers and supply chains. So what we've seen is that if you have GPU mining, you'll have a more diverse participation set, including sort of like indie or more bespoke miners of, maybe someone has a extra computer or someone has like one or two rigs running in their garage. They can profitably do that in a GPU setting, whereas ASICs, it's a little bit harder to do. The other thing about GPUs is we see them as geostrategically resilient, right? So the ability of nation states to control the dissemination of goods across their borders is very good. So if you have an application-specific piece of hardware and a country says, we don't want you to ship that, you're going to be able to control that as a country. So they have the ability, if you pick an application-specific chip, to control that flow of that good, and therefore can control the access to the network. Right, but with GPUs are used for many things. So if a government decided, oh, I'm going to try to shut down the import of GPUs, well, then you're not going to be able to do AI. You're not going to be able to do, language models. You're not going to be able to do rendering. You're not going to be able to do a lot of different things. You're not going to have gaming, right? So you're going to very much injure your economy by doing or controlling that. So we see GPUs as being less controllable. Which then means it makes the network more accessible, both in terms of the economics of mining with GPUs, but also just the ability to ship, import, and export them. And that's why we chose it. Now, if I'm playing devil's advocate on GPUs, a lot of people say that like what secures the Bitcoin network is the capital sunk cost of ASICs, right? But we've actually come up with an interesting system wherein we have GPUs, but miners can actually choose to defer when they get their rewards unlocked to get a different rate of reward.
Ah,
Okay?
okay.
So then what that does is it forces miners to make a capital choice about the system, which then, even though we're mining with GPUs, puts the miner's skin in the game on a longer time frame, just like an ASIC would, right?
Mm-hmm.
So basically the way it works is there's a cooling off period just like Bitcoin, but if you choose that, you sort of get the natural rate in the system. But if you defer it for 3, 6, or 12 months, at 12 months, you'll get 25% more than you would if you took it instantaneously.
Interesting. Okay.
Right? So then what that does is then it makes the miners more sticky to the network because they're investing capital in the long tail, just like they would with an ASIC. So we can have this like nice property of ProgPoW and independent miners, but we make them sticky to the network because they'll naturally want to choose longer duration rewards.
Mm-hmm. And just out of curiosity, was CPU algorithms considered before going ProgPoW?
Yeah, so we considered CPU algorithms. Um the issue that we were having was the um the verification times. So like in our system, right, in this sort of merge mined hierarchy, as you get more shards, um when you process these what we call, prime blocks or dominant blocks, sort of when state sort of transfers to one shard to another, you have to do a lot of validation of a lot of blocks quickly, and the validation times on things like RandomX were too high per unit to really be able to work at high throughput. So there were like considerations there. Um, that was, I think, our principal consideration from RandomX to ProgPoW.
Okay. Now, I know all the miners that are listening to this at some point are going to get really interested and they're going to want to know what their options are for wallets. What type of adoption do we anticipate with exchange listings and stuff like that? If you could just kind of talk to them for a moment and tell us, are we looking at CLI wallets? Are we looking initially at a web wallet? Obviously we want people to be focused on a lot of different things. Nodes are very important, and it does really help get bootstrapped adoption whenever we require nodes, so to speak, for a wallet. But to kind of make things easier on those who want to get involved, how quickly do you see things like wallets progressing and stuff like that?
Yeah, so in the Golden Age testnet, we have the sort of in-house wallet that we've developed. It was based off a fork of Tallyho, so it's a web extension wallet. We call it Pelagus. And that's available and that works. There's also an integration partner that's not part of Quai called Koala Wallet, and they've also created an integration for Quai and Qi, and those will be available in this testnet. Going forward, there's a couple other people that we're talking to, some bigger wallets and mobile-based wallets that people could potentially use, but that'll be kind of like a mainnet integration. So there's options, and then obviously you can also use the CLI if you want to go there. In terms of exchanges, right now we're talking to two. So L Bank and MEXC, we anticipate to be listing us basically at launch.
Gotcha. Awesome. Okay. And as far as mainnet is concerned, we are in our current last test net now. Um, Obviously, we don't know exactly how long that test net's going to take because we don't know what potential bugs and things that we need to work out of there. But do you have some general expectations on how long you think it'll be before we get to mainnet?
Yeah, so I think on the long end of Golden Age, it would run 8 weeks. On the short, maybe 5. It's kind of like my over under. We're really interested in trying to get mainnet done in December, um, but it may go to January depending on how things go. But I would have a high confidence interval on December and January.
Awesome. Okay. Um, we're getting close to the end of this because I don't want to take too much of your time. I know you've got a lot on your schedule today, and again, thank you for making an appearance here today. Um, I wanted to kind of just get your thoughts on the general landscape of crypto, maybe future expectations around
Can can
things.
can 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 I throw one other
Yeah,
feature of the system out that's
yeah,
kind of cool to
absolutely.
miners, and then we'll do that. The um the other thing that's cool about this system is we've introduced this concept called work shares. So basically, instead of just getting paid for a block, you also get paid for shares. So like you know, participate in a mining pool, you submit shares to the mining pool eventually finds a block and then distributes it relative to what they measured your hash rate to be based off the number of shares that you submitted. In the system intrinsically, each block has 15 shares. So, as a miner, instead of, yeah, and we have 5-second blocks. So the rate at which you're paid as a miner, even if you have very little mining hardware, is pretty high. So even if you had, say, like a single GPU and this was like a wildly successful network, you still might expect to get paid every couple days, which means that there's a very low incentive for you having to go to a pool to make sure that you get paid, right? This is like built into the system. So if I try to simplify it, you can think of the protocol as having something akin to Stratum v2 in the protocol itself.
Interesting.
Um,
Okay.
yeah, and that does a lot of work for us in terms of like other things like making finalization faster, uh, fixing that thing about propagating transactions and so on and so forth, making transaction propagation DDoS resistant. So even that like concept is doing like 4 or 5 different things for us. But from a miner's perspective, it means that you don't need to join a pool to get paid. The pool exists in the protocol.
Interesting. I'm glad you brought that up because that was one of the things that I kind of glazed over when we talked about the algorithm and exchanges and wallets and things. And that was going to be pools. And with that being built in or baked in, so to speak, do you still foresee that there are going to be pools? And do you guys currently have anybody that you're kind of working with right now that's going to be launching any pools after mainnet?
So we actually had someone put up a decentralized pool last testnet.
Okay.
So we expect to have a couple in this testnet. We as an organization are friendly with a number of miners, including pool operators. Um, we haven't sort of gotten commitments. We think they will do that. Um, but there will be sort of indie pools that get set up. So the question you have to ask is like, why would you run a pool? The reason you would run a pool is because you don't want to run a node. But that like infrastructure you need to run a node is relatively low, right? So there still is a demand for pools because the node requirement isn't zero. So people may still want to run a pool, and they're going to have to pay a percentage for whatever that is, to those pools. Um, but you can run it in this sort of decentralized way too, right? So the way sort of the decentralized pools work is you just sort of point your strata or your miner at their stratum endpoint, and then what they do is they will produce block proposals for you 99% of the time, and then 1% of the time they'll produce, say, a block proposal for themselves, and then you're just mining sort of all the time, and you don't know whose block proposal you're working on. You just work on all block proposals, and that's how you kind of create a decentralized pool. So when people set those up, they're basically just running a node, and then they're inserting their sort of reward address 1% of the time, sort of to get their 1% fee. So that existed in the last testnet. We expect it to exist in this testnet. I don't think there's a need in this system to have like sort of like your mega pools, like your P2 pool or anything like that. Because there's a low need for pools already because payouts are so fast. And then if you really don't want to run a node, there's like this concept of a decentralized pool. Um, so maybe centralized pools get set up, but there's a much smaller need for them in this architecture.
Interesting. Yeah, it'd be really cool to see how all of this shakes out at the end. I'm sure there's other things that I probably glazed over that you want to rehash out. So, I'll just give you the opportunity to maybe elaborate on some of the things that we've talked, or maybe some of the things that we've missed. Is there anything that you want to convey to the audience?
Yeah, I mean, what we're trying to do with Quai is we're trying to fulfill Bitcoin's original vision, right? The thing that got me interested was very libertarian, which was creating money that's independent of the state. Having seen what has happened over the last 12 years, I've understood technically, game theoretically, and economically what needs to be produced to make a system that can function as money at a global scale that's independent of the fiat system. That is what we're trying to build.
Awesome. And I'm here for that. Well, I do want to kind of get your general thoughts on future expectations of things like regulation, integration, the broad landscape of where we're at and where we're going. So, it's always fun to hear people's opinions on that type of subject matter, and coming from someone such as yourself, I think it could be insightful to a lot of people that are still here watching. So,
Yeah, so I mean, in terms of regulations, depending on where they go, I think my macro view is that it's going to be beneficial to proof of work. Because most of the properties that people want in these systems um, will potentially get diminished or go away entirely, depending on the type and degree of regulation that's implemented in proof of stake systems. If you look at how they're structured and who operates them, they will be regulatable, 100%. If you look at a proof of work system, um, what ends up happening is it kind of gets, if there's something onerous about it, the infrastructure providers will get smushed sort of out of onerous jurisdictions and go elsewhere. So it's resilient to regulation. So like a great example would be Bitcoin and the Chinese miners, right? China said, "Oh, we're going to ban mining in Western China." They just moved to West Texas, right? If like West Texas bans it, like they'll go to the next place. Um, so the cool part about these systems is that they're these economically Byzantine fault tolerant decentralized systems, and so it makes them so that the protocol is the protocol, and no one can really change the protocol, even through regulation, right? Like people can independently say like put regulations on citizens, but the protocol is not going to adjust to it. The protocol is going to be the protocol. They're going to have to go try to clamp down on exchanges, or if you're say like a wallet provider, or if you're a miner, they're going to make you register and um, KYC, your hash rate that's coming in. If you're a pool, whatever it may be, that's fine. What's going to end up happening to those onerous jurisdictions is they're just going to lose out on the market and production, and things are going to go elsewhere if those restrictions are onerous. So that being said, what the sort of macro here is proof of work is resilient to this stuff, and it's going to preserve the underlying properties of the system. I don't think proof of stake is going to do that. So if regulations become more onerous, I think stable tokens, fiat-backed stable tokens, are going to become much less attractive and much less useful. And I think of things that are built on proof of work systems are going to do the same. So I believe we're kind of at an inflection point in crypto where in 2 to 3 years' time, the only thing people are going to be talking about is work-based systems.
interesting. Well, I personally would love to see that happen, and I am sure that the rest of the audience would probably agree. Um, well, man, before we wrap up here, I want to give you the opportunity to tell people how that they can get involved, and maybe where to find some of this important information. There's a lot of subject matter that I would love to cover, such as, we'll say tokenomics, emissions, but all of those things are a bit different from some of the other projects because it's kind of a moving target. So if you could just briefly tell us, how to get in touch with the team, how to voice their opinions, where to find the information, and just how to stay involved.
Yeah. So website is qu.ai, and if you go to docs.qu.ai, you'll find information about the protocol, all of these cool features. It'll have information on how to set up a node, how to set up a miner, how to participate in the Golden Age testnet. Um, Yeah, and if you want kind of to interact with the team, the best channel is probably Discord. So there's, the Quai Discord. If you're more technically focused, there's also a development Discord if we're talking about like code related items that you can jump in. So yeah, looking forward to it.
Awesome, man. This was a lot of fun, and I am going to hit you up. And next time I'm in Austin, we'll come and hang out there at the studio and visit with you guys.
Yeah, absolutely. If we want to do another round and talk more about tokenomics or whatever tickles your fancy, we'd be happy to do it.
Awesome, man. Yeah, I'll probably be hitting you up closer to Mainnet. I'll be paying attention. And just full disclosure, I've been aware of Quai for over a year, and I really didn't start digging back into the project until I started seeing, this is going to be the last testnet. And then I'm like, oh my gosh, I've been missing out on everything. I got to get caught up. So hopefully the opportunity arose, you guys took it, and now the audience is aware of everything that's going on, and we'll keep them up to date.
Appreciate it.
No problem, man. All right. I think that's going to wrap it
Thanks.
up. You guys have a good one.